Hey everyone, I hope you've all been safe and healthy, practicing social distancing, washing your hands, and not touching your face. It's been a turbulent scene in the markets lately with the S&P 500 dropping over 30% in under a month, climbing back up 15% this past week, ultimately leaving us still in bear market territory to end the week down 24% from February 19th's all-time high. We're bound to experience more volatility as supply chains are disrupted, challenges to the healthcare system compound, and unemployment continuing to spike with people stuck indoors as more and more states issue statewide lockdowns. For a lot of us, that means we're working from home, maybe stocked up on toilet paper, or perhaps fighting over toilet paper at Walmart like these people. There are some of us thinking of better days when the events of 2020 are behind us, and we can look back and remember on this year with our commemorative jewelry. 2 weeks ago, a day before our state started issuing closure of non-essential businesses, my girlfriend and I adopted a 7-year-old cat named Gigi, and she's been a joy to have around since we've been cooped up, working from home. She's very fluffy, and as High Queen, she loves looking down from her castle at us common folk. If we turn to my investment portfolio, as shown on Personal Capital, I hit an all-time high of $113,000 about a month ago, but that quickly changed, and now, including all my automatic contributions, I'm down about 16%, shown in blue, from my all-time high compared to the total US stock market, shown in orange, which is down about 25.5%. You can see that I've also selected a time period, a custom time period of February 19 to March 28 as an end date, which is a nice feature within Personal Capital to be able to specify a particular time period. If I go to my allocations tab, as discussed in my earlier videos, besides stocks, I track US bonds and international bonds in my 401k and Roth IRA, and I have a sizable tax position that I've been building up for times like now, shown here. Bonds and cash have acted as buffers, protecting my portfolio from the drops stocks have recently experienced. If I go to my holdings tab, shown at the top here, and I organize by type as well as value, and we scroll down a little bit here. Since my last video, I've dialed up my stock allocation in my Fidelity 401k, which means my future contributions will be allocated such that 75% goes towards the S&P 500, which is FXAIX, and 25% goes towards the US bond index, FXNAX. These two funds shown here comprise my entire Fidelity 401k. Changing my allocations will allow my future contributions to buy stocks at a cheaper price than what I was buying them before. If or when the S&P 500 drops more by, say, 10%, I'll dial up my stock allocation another 5%. I'll also be rebalancing my portfolio in the next few weeks, which would sell off some of these bonds here and then go to repurchase some stocks in my S&P 500 fund. Again, it would be at cheaper prices since the market has been dropping. If I go back to my allocations tab here, this is again my favorite view that Personal Capital provides me with. And Personal Capital is a simple and free platform that I use to track my investment portfolio. It's really easy to sync up accounts, and the platform automatically and intuitively categorizes investment data, providing me with that useful, relevant information with a few clicks, and I even have it on my phone. Has a really easy to use phone app for iPhone. There's a lot of speculation and noise surrounding what's going on in the markets and economy. One voice of reason I like to turn to is Vanguard, especially since most of my net worth is with Vanguard. Chief global economist Joe Davis anticipates a deep recession with the U.S. economy contracting around 20% over the next several months, which would be the largest single quarterly drop in our history since at least World War II. Here's a clip from the video.
What's your team's thoughts in terms of the likelihood that we're going to enter a recession and what you would be looking out for?
Well, unfortunately, Greg, the U.S. economy is going to enter a deep recession. The nature of the efforts to contain the virus has also led to closures or suspension of a lot of business activity, particularly the service sector. And so our estimate is that the economy will contract on an annualized basis, perhaps as much as close to 20%, which is significant.
Mm-hmm.
Joe goes on to explain that one possible upside is if things get better by the end of the summer and severity weakens, the recession could be short-lived, making it one of the shortest recessions in U.S. history ever, especially when compared to the previous great financial crisis, which had a 6-year recovery time for the S&P 500 to return to its previous all-time high.
That is our baseline assumption. If that occurs, that towards the end of the summer, the U.S. economy is actually growing again, which would mean that the recession, although it'll be very deep, ironically, could also be the shortest in our history.
Which would be great news.
Which would be great news. Now, we would climb out of it. It would take a little bit of time, but I think, again, part of this has been, the ability of consumers and businesses to pursue economic activity rather than the willingness. And so that would dictate, all else equal, the recovery should be so much stronger, and certainly stronger than coming out of the fiscal crisis in 2009, 2010.
Before getting into what I'm buying in this current market, as always, make sure you have enough cash for emergencies like the one we're in now, and do your own research before investing your hard-earned money. You should be careful of blindly copying others on YouTube or social media. I am not a financial advisor, and everyone is in their own unique financial position. With that said, here's another view of my investment portfolio as of March 28th, 2020. As I said before, bonds and cash have acted as a protective buffer while my stocks have been taking a beating. I am still auto-investing and staying the course in my retirement accounts. One slight change from before is that I've dialed up contributions to my taxable cash position in VMFXX, which is Vanguard's federal money market fund, and that's because I'll be deploying my current cash position into the following funds. Those being VXUS, which primarily tracks international large cap stocks, VDIGX, which tracks 42 companies with histories of growing their dividends, and 10% of that fund is allocated towards international companies. And last but not least, QQQ, which tracks the NASDAQ 100 index. The current situation is causing severe business disruption to many sections of the economy, with some of the hardest hit industries being travel, leisure, retail, and restaurants. What makes QQQ more attractive right now is that it tilts heavily towards the tech and communication services sector. So while these types of companies will experience decreases in online ad sales, they should see less of a devastating decline in business and may even see boosts in some online activity and purchases with so many people stuck at home. In my next video, I'll discuss what I'm buying in my smaller M1 Finance taxable account, which is more of an experimental stock picking account. There's less than 15% of my investment portfolio with M1 Finance. To conclude today's video, maybe we can take a breather and remember Mr. Rogers' wholesomeness in this uncertain, bizarre situation we're all going through as a collective species. Thanks everyone for watching. Stay safe, wash your hands, and keep up the social distancing. Gigi also wishes everyone good health and happy vibes.